Have you ever really thought about the hidden costs behind, say, a huge new corporate building, yeah, beyond the obvious stuff like bricks and mortar? What about the interest on all the money borrowed for it? Is that just, an everyday expense? Or does it somehow become part of the building itself? Welcome to the Deep Dive. We're the place that takes these complex topics, cuts through the jargon, and gets you those surprising insights. Today, our mission is to tackle something called interest capitalization in accounting. Sounds a bit heavy, maybe, but it's absolutely key to understanding how companies value their big assets. We're actually going to walk through an example step by step, showing how you figure out how much interest gets added to an asset's cost and how much is just, expensed. Okay, but before we properly dive in, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, the examples, the explanations, it's all derived from the accounting resources over at farhatlectures.com. So whether you're maybe studying accounting, prepping for the CPA exam, or you're already a professional, do check out the website. They've got more practice questions, video lectures, and detailed support for today's topic. Special thanks to Professor Farhat for providing this great material. All right, let's get into it. Picture a company, let's call them Mainco. They're starting a big project, a new building.
Right. And Mainco kicked this off by borrowing specifically for this project. They took out a $3 billion loan on December 31st, 2016.
Right.
And the interest rate on that was 12%. This is what we call a specific borrowing because, it's tied directly to funding that building.
$3 million at 12%, specifically for the building. Got it. But that's probably not their only debt, right? Big companies usually have more going on.
That's exactly right. Besides that specific loan, Mainco has other debt on its books. They've got a 10-year bond out for $4 million, carrying a 13% interest rate.
Okay.
And also a 6-year note for $1,600,000 at 10% interest. These are their general borrowings, not tied to this specific building project.
Right, general debt versus that specific construction loan. And building something like this, the money doesn't all go out the door on day one. They spent money throughout 2017.
Correct. The spending was spread out. Can I walk you through the key dates?
Please do.
Okay, so in 2017, on March 1st, they spent $360,000. June 1st, another $600,000 went out.
Okay.
July 1st was a bigger one, $1,500,000. And then finally, on December 1st, another $500,000.
Wow. Okay, so if I add those up, 360 plus 600 plus 1.5 million plus another 1.5 million, that's $3,960,000 spent just in 2017.
Dude, that's the total expenditure for the year, yes.
And the building wasn't finished until February 2018. And they also had some interest revenue, $49,000.
Yes, they did generate some interest revenue, $49,000. We'll come back to how that's treated. But the main puzzle here, the real challenge, is figuring out this. Out of all the interest Mainco paid in 2017 on all its loans, the specific one and the general ones, how much gets capitalized?
Meaning how much gets added to the cost of the building itself on the balance sheet.
Exactly, versus how much just gets reported as interest expense for the year 2017.
Okay, so that's the core problem. How do we start solving it? You mentioned something, weighted average accumulated expenditure, WAAE.
Yes, the WAAE, that's the crucial first step.
Why is that number so important? What does it actually tell us?
Well, the WAAE gives us the average amount of money tied up in the construction project throughout the year, weighted by how long each expenditure was outstanding.
So it's not just the total $3.96 million spent.
No, because that money wasn't all spent on January 1st. Some was spent later in the year. The WAAE reflects the average investment base that was, theoretically, accruing interest costs related to the construction.
Okay, that makes sense. So how do we calculate it for Mainco based on those 2017 expenditures?
Let's break it down. The $360,000 spent on March 1st, that amount was outstanding for 10 months of the year, right? March through December.
Right, 10 out of 12 months.
So we take $360,000 times 10 till 12. That gives us a weighted amount of $300,000.
Okay, $300,000 for the first chunk. What about the June payment?
The $600,000 on June 1st, that was outstanding for 7 months, June through December.
7 months, so $600,000 times 7.
Exactly, which comes out to $350,000.
Got it, $350,000. And the July one, that was $1.5 million.
Right, July 1st means it was outstanding for 6 months, half the year.
Okay, $1,500,000 times 612. That's $750,000.
Correct. And the last one?
The December 1st payment, another $1.5 million. That was only outstanding for 1 month, December.
Just 1 month. So $1,500,000 times 112.
Which is $125,000.
Precisely.
Okay, so now we add all those weighted amounts up. $300,000 plus $350,000 plus $750,000 plus $125,000.
What do you get?
Let's see. That's $1,525,000.
That's our weighted average accumulated expenditure, $1,525,000.
Wow, that is really different from the nearly $4 million they actually spent. It really drives home that timing matters a lot here.
It absolutely does. And this $1,525,000 figure, that's the number we need.
Yeah.
It's the base for calculating what we call avoidable interest.
The avoidable interest, meaning the interest they theoretically could have avoided paying if they hadn't done this construction project.
It's that idea, yes. It's the amount of interest cost the construction project is considered responsible for.
So we have the WAAE, $1,525,000. How do we get from that to this avoidable interest number?
Okay, now we bring back that specific construction loan. Remember, Mainco borrowed $3 million specifically for this building.
Right, at 12%.
Now, compare that $3 million specific borrowing to our WAE of $1,525,000.
The borrowing, 3 mils, is much bigger than the 1.525 M.
Exactly. And because the specific borrowing covers the entire WAE, the calculation for avoidable interest is straightforward in this case. We just take the WAE, $1,525,000, and apply the interest rate from that specific loan.
So $1,525,000 times 12%.
Yes. Calculate that out.
Okay, 1.525 million times 0.12. That equals $183,000.
That's it. The avoidable interest is $183,000.
So $183,000 is the theoretical interest cost generated by the average funds tied up in construction during the year based on the specific financing obtained for it.
You've got it. That's the maximum amount of interest that could potentially be capitalized.
Okay, potential. So that's not necessarily the final answer for what gets capitalized.
Not quite. There's one more piece we need. We know the avoidable interest. Now we need to figure out the actual total interest the company incurred during the year on all its relevant debt.
Ah, okay. So we calculated the theoretical part. Now let's look at the reality. What did they actually pay out in interest across the board?
Exactly. We need the total picture of their interest costs for 2017.
So we need to look at all 3 loans, the specific one and the 2 general ones.
Correct. Let's calculate the interest for each. First, the specific borrowing. $3,000 at 12% for the full year.
Okay, 3 million times 12% is $360,000.
Right. That's the actual interest on the construction loan. Now, the 10-year bond, that was $4,000 at 13%.
4 million at 13%, that's $520,000.
In fact, another chunk of actual interest. And finally, the 6-year note. $1,600,000 at 10%.
$1.6 million at 10% is $160,000.
Yeah. So now add those 3 actual interest amounts together.
Okay, $360,000 plus $520,000 plus $160,000. Carry the 1. That's a $1,040,000.
$1,040,000. That's the total actual interest Mainco incurred in 2017 across these debts.
$1,040,000. That's a lot of interest.
Yeah.
Okay, so now we have the 2 key numbers, right?
We do.
We have the avoidable interest of $183,000.
Okay.
And we have the actual interest incurred of $1,040,000. Now, the big reveal. How much of that $1,040,000 actually gets added to the building's cost, and how much is just regular interest expense?
This is where the core rule of interest capitalization comes in. For assets a company constructs for its own use, the amount of interest you capitalize is the lower of 2 numbers. The avoidable interest we calculated and the actual interest incurred.
The lower of the 2.
Okay, so in Mainco's case.
Well, the avoidable interest was $183,000, and the actual interest was $1,040,000. The lower number is clearly $183,000.
Exactly. So $183,000 is the amount of interest that gets capitalized.
That's the magic number. So that $183K is added to the building's cost on the balance sheet. It becomes part of the asset.
Precisely. It increases the depreciable base of the building. It's not an expense hitting the income statement right away in 2017.
Okay. And what about the rest of the actual interest? That $1,040,000 they paid?
The rest is treated as regular interest expense for the period.
So we take the total actual interest, $1,040,000, and subtract the amount we just capitalized, $183,000.
Right.
Which leaves $857,000. That gets expensed.
That's correct. $857,000 hits the income statement as interest expense for 2017.
Got it. Capitalize $183,000, expense $857,000. And quickly, what about that $49,000 interest revenue they earned? Does that reduce the amount capitalized or anything?
Good question. Under U.S. GAAP, generally accepted accounting principles, interest revenue earned, even if it's maybe from temporarily investing borrowed funds, is treated separately.
So it doesn't offset the interest cost being capitalized.
No, it doesn't. That $49,000 is just recorded as interest revenue. You debit cash, credit interest revenue. It doesn't enter into the capitalization calculation itself.
Okay, that's clear. Wow. So we really unpacked it. We went from the initial loans and spending,
Calculated the weighted average expenditure,
figured out the avoidable interest,
compared it to the actual total interest.
and landed on the exact amount to capitalize, $183,000, which boosted the building's asset value, with the rest being expensed.
It's a neat process when you lay it out. And it makes sense, right? It's trying to accurately reflect the cost of creating that asset, including the financing costs incurred during its creation.
Yeah, it really highlights how accounting tries to match costs to the benefits over time, rather than just expensing everything immediately. That $183,000 is now part of the building's cost, to be depreciated over its useful life.
Exactly. It affects the balance sheet first, and then the income statement gradually through depreciation.
What stands out to you most about this whole calculation? For me, it might be just how significant that capitalized amount can be. $183,000 isn't small change.
I think it's the logic behind the WAAE calculation, really focusing on the average funds employed, not just the total spend, and then that crucial comparison, avoidable versus actual to the capitalization. It's quite elegant in an accounting sort of way.
It is. Okay, here's a final thought for you, our listener, to chew on. How might this practice of capitalizing interest, instead of expensing it all right away, change how investors or lenders look at a company's financial health in the short term? And thinking longer term, how might knowing you can capitalize some borrowing costs influence a company's decision about whether or not to take on huge construction projects? Does it make them seem perhaps a little less costly up front? Some of the